Hi, welcome to Chapter 10, Bond Pricing and Yield. In this chapter, we're going to go over the bond characteristics. But before I talk about the bond characteristics, let's talk a little bit about bonds. So, in contrast to stocks, bonds are more of a liability, or what we would call an IOU, where bondholders lend money to the issuer, which is a corporation usually, or it could be government. Bonds are publicly traded and are long-term debt securities with a variety of borrowers, including governments, government agencies, states, local governments, corporations, because bonds usually repay lenders by making fixed periodic interest payments and a fixed principal payment at maturity. They're often called the fixed income securities. So if you hear bonds are more oftenly referred to fixed income securities, like stocks are more oftenly referred to as equities. Now, like bonds, stocks can provide two kinds of income: current price, which would be like capital gains, and current income. So the current income comes from a bond's interest payments, and capital gains are going to arise from two factors. First, the bond's interest payments do not typically rise in step with the firm's profits, so the way stock dividends do. So bond prices are affected by a firm's overall financial condition. So profitable firms are more likely to repay their debts. So investors believe that an increase in borrowers' profits makes its outstanding debts or financial fixed in securities less risky. The price of the bonds are going to increase. Second, bonds prices do fluctuate with market interest rates. So in fact, interest rates and bonds move in opposite directions, which I call an inverse relationship. So when bond rates rise, let's say when interest rates rise, the bond prices fall, and when interest rates drop, the bond prices increase. So, and bond pricing of the bond works a lot like the stock, where supply and demand of buyers and sellers are what drives the price up or down. So imagine that you buy a new bond issued by a pretty reputable company like Starbucks, and it's going to pay $5 interest. So suppose that a month later the market rises and the new bonds coming out are going to pay 6% interest. So if you want to sell your old and busted Starbucks bond that pays 5% interest, you're more likely to experience a capital loss because the bond is going to have to sell at a discount to make up for the fact that it's only paying a 5% interest on its coupon, when the market rate is prevailing at 6%. So the Starbucks bond prices would fall and fewer buyers would be interested in them. So happily, the opposite is true when interest rates fall. So if the current similar bonds are going to be issued at 4%, then the Starbucks bond paying 5%, the bond price would increase to reflect the extra value of the bond, and then we'd call that a capital gain. Now, there are a wide variety of bonds available in the marketplace, and we're going to talk about many of them during this chapter. And a lot of them are relatively safe issues from big companies or big governments, and they're sought by many conservative investors who want, who may be scared of the risks of some stocks. But some bonds can be risky too. If you take a bond in a company that's not as financially well established, that could be a riskier situation. But if you can tolerate higher risks, there's certainly higher returns that you can make in the bond market as well. And so the risk and returns are going to depend on the type of bonds, the volatility of the interest rates, the financial stability of the company, and the length of the bond in the amount of years. Other bonds can have special features. Bonds, can be tax-free, which we call municipal bonds. The tax can have, it's different if it's a federal or a state bond. So that's a nice feature. Some bonds can have fixed interest rates, some bonds can have adjustable or floating interest rates. And those have different advantages and disadvantages as well. Now, if you look at interest rates as a driver to the bond market, the behavior of interest rates is the most important influence in the overall return you're going to earn with a bond. So that would have, there are other influences I mentioned before, but interest rates are the most influential. So interest rates determine not only the current income investors are going to receive, but also the capital gains or losses that the bonds are going to produce. So it's not surprising, therefore, that the bonds, the market participants follow interest rates very closely. So they're very sensitive to those interest rates. So anytime the news media or any type of government is adjusting interest rates, this is going to be of keen importance to bond investors because they're going to quickly be reflected into bond rates the same day. So this is something that is important. Now, as far as historical returns on bonds, we see that bonds have a return lower than equities or stocks. And it depends on the type of bond that you're buying, of course, but you're looking at treasuries, municipals, and corporates, they generally have a lower return and an annual basis than stocks. But on the other side of the relationship, bonds are less risky, and bonds can, produce can lower the overall riskiness of a portfolio by lowering its coefficient. So when compared to stocks, bonds are generally, I say for the most part, less risky and provide higher income. When I say higher income, the interest on bonds is generally higher than the dividends on stocks. So bonds are issued, by, like I was saying before, a lot of different companies and government bodies. So investors can construct well-diversified portfolios of bonds to help eliminate risks, just like they can do with stocks. So bonds are more limited as far as very high potential return. So bonds aren't going to turn into a 100% return, 200% return that some stocks can turn into. However, you may want to trade this. You're really trading this ability for strong growth for the safety of the bond and the safety of the money invested in the bond. So there are times when bonds outperform the stock market. And that's why they're good counterbalance to stocks in a portfolio. So there are times when stocks, of course, go into a free fall and crash. And a lot of times the bond market is stable or moving up during these events, which is make them a good counter, even if there is a volatile stock market. So I guess the biggest difference in returns between stocks and bonds usually come in during those bear markets when the stock returns are negative. So, this is what we might call a flight to quality, where investors pull their money out of stocks when the stock market is perceived too risky, and they're going to enter them into bonds, which is going to shoot up the returns on bonds. And this has happened during most financial crises. So many investors argue that if bonds earn a lower average returns, that's a small price to pay for the stability of the bond in the portfolio. So as a general rule, adding bonds to a stock portfolio will reduce the portfolio's overall risk dramatically, reducing its returns. But investors don't buy bonds for the high returns, except when they think the interest rates are going to be heading down quickly. So rather investors buy them for the current income and for the stability in the portfolio. Okay, so let's just talk about some basic bond characteristics here. So a bond, as I explained, is just an obligation to issue to make payments to a holder over time. So a company wants to raise funds, but they don't want to sell ownership in the company. They just want to raise some money. So they issue a bond, say for $1,000. Then in 10, 20, or 30 years, that $1,000 has to be paid back to the lender. In the meantime, the lender will receive interest payments on a semi-annual basis, typically to compensate for lending that money and time value of money. Now, the face value of par value, where is very important for bonds. Not so important for stocks, but for bonds, it's the value of maturity of the bond. So a bond could be born in $1,000. If that's the par value or face value, it's going to die at $1,000 or when it retires. But any point in between when it's born and when it's retired, the bond's price could change in relationship to the fundamentals of the bond. And that's how bonds can trade at a premium or discount to its par value. Coupon rate is the annual interest payment per dollar value of the bond. So it's a coupon that pays $1,000 coupon that pays a 5% is a $50 coupon that you're going to earn each year. Some bonds are what we call zero coupon bonds. And we say coupon because these bonds before the digital age used to come with a coupon book, and you'd rip out the coupon at the date of when your interest was due. And some coupons are zero coupon bonds, which means that the bond just sells at a discount, and then when it matures, you get the full value of the bond. So you might buy, say, like a savings bond. It's $1,000 savings bond, but you only pay $500 to buy it, and when it matures, you get the $1,000. So you get all your interest at the end of the maturity. Here's an example of price and yields of U.S. Treasury bonds. This is on the 2017. So you can see this is the maturity dates of these bonds, the coupon, and you see these different rates. And typically you see something interesting with the very longer bonds here. These have lower rates, which is interesting. And we have some short-term bonds with higher rate, higher coupons. The bid and ask, you see that some of them are if they're above 100, they're trading at a premium, and if they're below 100, they're trading at a discount. So this is like a percentage of the bond price. So this bond's trading at 102%, this bond's trading at 99%. So if it was a $1,000 bond, the bond would be trading at $9,971. So that's a discount. And this would be the change from the bid and the ask, or this could be the change from the day before, rather. And then the yield to maturity, what is going to yield to the maturity of the bond. Meaning that if your bond is coupon 1.75 and it's trading at a discount, the yield is going to be higher. Where if it's trading at a premium, the yield is going to be lower. Okay. So let's talk about Treasury bonds and notes. So they accrued interest in quotable bond prices. Now, interest for the Treasury bonds, you take the annual coupon payment and divide by 2 because it's a semi-annual interest structure. So you get your interest twice a year. So if it's a 6% bond, you're going to get 3% interest every 6 months. And if we take the days since last coupon divided by the days separating coupon payments, you can get the accrued interest so far on the bond. So bond prices do not include interest accruing between the payments, but you can calculate it here. Now, so here's an example. We have the coupon payment. This would be the okay. So this is actually going to be the dollar amount. So it could be interest rate, or here we're going to do this would be the dollar amount. So if this was 60 divided by 2, that's how we get to 30, and then the days would be listed here. So we would see that the accrued interest is $7.42 in this particular example. And this is a semi-annual 6% bond, so 6% times 1,000 is how we get to 60, divided by 2 is how we get to 30. 45 days have passed since the last coupon, and the accrued interest separating the periods is 182, which would be semi-annual. And that's how you can actually figure out the accrued interest there. Here's another listing of corporate bonds. So these are different companies. There's the symbol of the bond, and the bond symbol is a lot more complex than the stock symbols. The coupons, the date of maturity, the rating agency's rating of the bond, and it sort of works like letter grades A through F, but they can have different symbols here. And then it shows the high, the low, the last, the change in the yield on the bonds. So it's just an example of a bond quotation if you were to look it up in the paper. Okay, so let's move on to, so let's just talk about, bond interest and principal. So the bond is going to pay, typically most bonds pay interest every 6 months, and some might make monthly interest payments. If it's usually mortgage bonds will make the monthly interest payments. So we can have this, if we want to know there's 3 terms that are really the same thing. Par value, principal, and face value is the amount that the borrower is going to repay upon maturity of bond. So, and then the coupon is going to be what the rate of interest is on the bond. It can be expressed as an annual or a biannual amount, depending on how you're looking at the bond. So the maturity date is going to be when the bond actually matures. So there's going to be a fixed date when the bond is going to mature, and then the borrower is going to pay back the money to the lender. And the principal behavior of these bonds is going to be inversely related to the market interest rates, where bonds are going to trade at a premium or a discount. So now let's move over to the corporate bonds, and we can talk about the call provisions on a corporate bond. So corporate bonds can have these callable features, which means it's going to allow the issuer to call in the bond, which means they can basically pay it off early. So the bond, they can call it in before the actual maturity date. So borrowers may want to call a bond if interest rates drop after the bond is initially issued, just like you might want to refinance your mortgage if interest rates drop. So by calling older bonds with high coupon rates and reissuing at the lower rates, the corporate and governments can lower their interest costs. Thus, the call feature benefits the bond issuer, not the investors. So investors who buy a bond that are paying a high interest rate or coupon rate will likely see the bond be called away if interest rates drop significantly during the life of the bond. So this limits the interest income that investors are going to receive if the interest rates drop. But it also limits the potential capital gains on bonds because investors will not pay a large premium for a bond that might be callable in the near future. So there are three main types of callable bonds. They could be freely callable, which means it can be called and retired any time. Non-callable, which means they can't recall the bond. And deferred call, which means that the issue cannot be called until after some particular time has passed, maybe 5 or 10 years. In essence, it's non-callable for a particular period of time, then becomes freely callable after that. Now, convertible bonds are interesting because they can convert into stock. So whenever a bond has a special feature, the amount of interest they're going to pay is going to be lower. So if the bond, when you compare a bond that's convertible, so a regular bond that's not convertible may be at a 6% interest rate. But if it has the conversion feature, they'll be able to sell the bond with a 5% interest rate because it's able to convert. So a company like Amazon sold a lot of convertible bonds, which means that the bond is able to convert into stock. So you can actually take your principal and trade it at a certain fixed rate, usually higher than the current stock price for a set amount of shares. So the idea being, if the stock price increases greatly, then you can convert your bond to stock and take advantage of the stock prices. So it's a really nice feature. Now, puttable bonds, when we talk about puttable bonds, where holders may choose to exchange a bond for par value or extend for a given number of years. So it means that it could be put to the future, we can kind of say. So that's a nice feature too. And then floating rate bonds, this is where the actual rates of the bond is going to float in relationship usually to the market rate. So now, because you're going to allow the bond rate to float, the interest rates are usually issued at a discount. But this is dangerous for the issuer, because if interest rates go up, they're going to have to pay more for the bond. And it could be advantageous for the bond purchaser, because if interest rates go up, they'll get paid more interest. And it makes the bonds less risky when interest rates increase because you're getting additional compensation. So let's talk about preferred stock. So now preferred stock, it acts more like a bond than stock. So it's a hybrid type of investment that lives between stocks and bonds. So the preferred stocks will pay a fixed dividend, much like bonds do. And preferred stock can actually have floating rate, but those are not as prevalent as the fixed dividend. Now, dividends are not normally tax deductible by the corporate side, where corporations can deduct interest payments. So that's sort of a drawback. The So corporations that purchase other corporations' preferred stock do have a 30% discount of the dividends received as far as the tax. So there is, some provisions here, and that's the U.S. only. Now, the preferred stock, as far as the lender's concerned, they don't have to ever pay back their principal, like when they sell common stock or equity. However, they do have to maintain this fixed dividend forever. So oftentimes companies do, when the financial setting is better and they have excess cash, they will call these preferred stocks and repurchase them to eliminate that dividend obligation. But they don't have to do that until they're ready. So it gives a lot more time flexibility to the corporation. Now, of course, different state, local governments are called municipal bonds, and they can have these bonds are generally issued so governments can raise money to do public projects. And they're going to usually have a tax-free status, which is going to mean that they are going to offer lower interest rates than the prevailing bonds. And these, domestic could be in the form of, these are government-related bonds that could be specifically to help raise money for home. People want to borrow mortgages for farm agencies. So in the U.S., we have the Ginnie Mae, Fannie Mae, and Freddie Mac institutions, which are government-related, that issue bonds that are discounted for the purpose of raising funds to fuel the mortgage market. Now, of course, depending where you are in the world, there are international bonds, which are foreign bonds that are going to be issued in, if any country than your home country where the bonds are sold. And they're going to be denominated in the currency of the country that they're issued. So you could have bonds issued in Canadian dollars or Mexican pesos or the euro. You can have bonds, issued in any real currency. But euro bonds... Now, Eurobonds, in contrast, are a bond that could be issued by a country or banking institution in a country where the currency is not the same as the currency of that country. So you could have banks in Germany issuing Eurobonds in dollar denominations. So it's just another type of bonds. I think we've talked about that before. So innovation in the bond market, just like most financial markets, there's a lot of innovation in the bond market, like there is in the stock market, like there is in, a lot of financial engineering occurs. So in the bond market, they have this, what they call inverse floaters. So the coupon rate falls when interest rates rise, which is an interesting setup, and it could be a good hedge or balance in your bond portfolio. And so it's the opposite of what bonds usually do. So bonds, usually the coupon rate increases when interest rates rise for new bonds. Now, the asset-backed security bonds, these are going to be bonds that are going to be backed by specific assets, such as mortgage-backed securities or credit card-backed securities, auto loan-backed securities. So it's backed by some sort of collateral or asset to the bond. And they can be very creative, innovative in these areas because, if there's any pool of debt, whether it's credit card debt, mortgage debt, student loan debt, they can securitize it and use the assets that it's tied to as collateral to issue out to investors. So the idea is that if you made a bundle of 1,000 mortgages, and it was asset backed by those mortgages, the bonds would be very safe and issued at a lower rate. However, if you look at the financial crisis of 2008, you see that those mortgage-backed securities were filled mostly with junk mortgage bonds, and had a devastating effect and helped to create the Great Recession. Paid-in-kind bonds, so issuers can pay interest in cash or additional bonds. So you can get, instead of getting actual cast, you get additional bond as an interest payment. Not so common. Catastrophe bonds, so higher coupon rates to investors for taking on extreme risks. We have index bonds. So these are payments tied generally to a price index or a price of a particular commodity. And we have TIPS, which are Treasury inflation protected securities, where these bonds are going to be tied to the inflation or consumer price index. So if the consumer price index increases, these bond yields are going to increase. And here, down here, we have the formulas for nominal return and real return, something we covered before. But interest plus price appreciation divided by initial price would be the nominal return, and then the real return would be 1 plus the nominal return divided by 1 plus inflation minus 1 would be the real return, which means what you're actually receiving after you factor out inflation. Okay, so if we look at principal and interest payments for Treasury and inflation protected securities, we see here if inflation changes, so over time, the inflation at the year ends. So inflation here goes up and then down. The par value of the bond will reflect the change in inflation, and the coupon price will reflect that change of inflation as well. So you can see that this is going to compensate for changing inflation. And it's very, inflation's been tame for a long time. So there hasn't been too much interest in these tips. But as an inflationary environment develops where, say, governments are printing a lot of money or borrowing a lot of money or giving a lot of money out to its citizens, this could create an inflationary environment where these tips might be more of a draw for investors. Okay, so bond pricing. Now, with bond pricing, we want to look at the present value of the coupons as well as the par value. And we want to figure out, we need to know what the maturity date is, the coupon rate, and then we could calculate the bond price. Now, this is something that I'm going to show you how to do in Excel. It's a lot easier with Excel. But here's the basic formula. But there's no need to really worry about the math of the basic formula, because I'm going to show you how Excel can easily price bonds in a separate video following this video. So if we had two bonds, this is an example, bond A and bond B. And we have the maturity, coupon rate, discount rate, and the par value, which we also call the future value. So these are just the symbols that we're using in the formulas. So if we put those symbols and the corresponding values into the formula, we could calculate what the bond price is. Okay, for both. So we could see that bond B, the price is selling a bigger discount than bond A, and that's because bond B has 30 years to maturity and bond A has 4 years to maturity. So the length of the maturity is going to affect how volatile the underlying bond price is to the change in interest rates. So it's a good illustration of that. And so this is the present value of the coupons. Then I'm going to add to it the present value of the par value, and then the total value. Okay, so prices fall as the market's interest rate rises. So this is the inverse relationship I was talking about before. So bonds with longer maturities are more sensitive to these fluctuations than bonds with shorter maturities. So fluctuations in interest rates, as we showed in the previous slide, is going to more greatly affect the pricing of longer term bonds and shorter term bonds. And that's why longer term bonds are typically considered more risky than shorter term bonds. So you can see this inverse relationship displayed here, where here's the bond price. So as interest rates increase, the price of the bond drops greatly. So here at, say this is 8%, the bond's valued at $1,000. If interest rates go up to 10%, the bond's now valued at $810. So you see this inverse relationship. As interest rates go up, bond prices go down. So we could look at, here are the bond prices at different interest rates. So these are the different times of maturity. So we're going from 2 to 10%. So with a 1-year maturity, we see we don't discount a great deal for a 1-year maturity, but a 30-year maturity, we're going from a bond value of 2,300 all the way down to 800 as the interest rates go from 2 to 10%. Now that's a huge swing. It's very rare that interest rates will swing that many basis points, but it's possible. But that's going to affect the maturity, and that's really the risk of investing in bonds. Now, the bond pricing between coupon dates, so we can do a bond price, which is going to be the flat price plus the accrued interest. And we're going to use this, again, I'm going to show you this in Excel, where we're going to use the function price to input the inputs to calculate what the bond price should be. And this is a preview of what the Excel file is going to look like that we're going to work on and provide some examples for you to complete, so you get an idea how to calculate the flat price and how to calculate the invoice price over time. Okay, let's talk about yield to maturity. So I'm going to show you how to calculate yield to maturity, current yield, and in Excel as well. So the yield to maturity is the discount rate that makes the present value of the bond's payments equal to the price. So it's basically saying if you buy a bond at a discount and it's paying a 6% interest rate, you're actually getting the yield to maturity might be 8% because we're going to factor in that discount that you're paying versus the difference between the par value and the price you pay. So the current yield is going to be the annualized coupon divided by the bond's price will give us the current yield. So even though the bond says it's a 4% bond, if you divide it by a rate, the actual coupon, $40 divided by not 1,000 but now 800 because it's selling at a discount, we have a higher yield. So premium bonds are selling above the par value, discount bonds are selling below the par value, and again, this occurs when interest rates change. So here, this is the yield to maturity formula that we're going to be calculating in Excel. But basically, we use the inputs of the date, the bond rates, the bond price, flat, the redemption value, and the coupon payments per year, and we calculate the yield to maturity. So yield to call. So this would be calculated like a yield to maturity, but we're going to use the call time to replace the maturity. So it's just basically saying, if there's going to be a call in place, what is going to be the yield to that call? So premium bonds are more likely to be called than discount bonds because there's an advantage to the corporation to doing that. So if we look at the callable bond, as far as the pricing and the interest rates, a straight bond is going to have a more predictable curve, where a callable bond, until it's separated, is going to have a different path as how it's going to be reflected in the price because of that call feature. Okay, so realized compound returns versus yield to maturity. So when we talk about a realized compound return, the compound rate of return on a bond with all its coupons and reinvested until maturity. So here we're going to get interest on our income. So we're assuming that we can reinvest the coupons at that same rate. Now, in horizon analysis, it's going to be analysis of bond returns over a multi-year horizon. So it's going to be basically a forecast of bonds, yield to maturity, and investment options. So that's another tool. The reinvestment rate risk. So there's some uncertainty about the future value of reinvested coupon payments. They may not actually be able to be reinvested at the same rate of the bond. So that's going to complicate some of the calculations of your actual returns. So here, if we assume a reinvestment rate at 10%, we could calculate the future value of the bond at 1,210. But if that reinvestment rate drops to 8%, the value of our overall bond is going to be a little bit less because we're not being able to reinvest the bond at the 10%, reinvesting at 8%. So the growth of the invested money changes with whatever the investment rate is. Okay. So yield to maturity versus the holding period return. So the yield to maturity is something we're going to calculate if the investment is held until the bond matures. But the holding period return of a particular investment depends on the market price at the end of the period that you're holding it. So you may not hold the bond to maturity. So these are going to be two separate calculations. Now here is a pretty common chart that we could look at when we're talking about the time from 0 to 30 years and the percentage of par value for a bond. So these are 30-year bonds. That pays an 8% coupon. So at the if the bond is about to mature, it's going to gravitate back toward the 100% of par value as it gets close to its maturity. But when a bond has 30 years worth of life in it, and we see that if the current bonds are going to be trading at a 12% coupon versus a 4% coupon, this would be the amount of dispersion in return. So if your bonds issued that these are going to be, say, your 100% of par value is going to be your bond at 8%. If bond prices the next day rise to 12%, your bond is going to trade. Those new 12% bonds are going to have a higher percentage of par value because they're going to be worth more compared to bonds that have a 4% coupon going to be worth less. So your bond is going to be related to those two as far as percentage. So if your bond has a disadvantage, it's going to trade at a discount versus trading at a premium. Okay, so as it gets closer to maturity, though, this premium or discount is going to dissipate because there's fewer years to actually collect the differential. So here you have 30 years to collect the differential in the interest, so it's going to be reflected more in the bond price. Here you only have a few days left to collect, so it's not going to really change the par value much of your bonds or the percentage of the trade to par value. Okay, so let's move to zero coupon bonds and treasury strips. So a zero coupon bond, like I explained earlier, they carry no coupons, they make no interest payments until the bond is fully matured. So just like a savings bond is what we would call it in the States, which means you could buy a $100 bond for $50. So when it matures, whatever the time frame is, you get the full $100. So you get all your interest at the end of the maturity of the bond. Now, a separate trading of registered interest and principal would be called a strip. So this is, you're basically creating a zero coupon bond from a coupon bearing notes or bonds. So if trading of treasury strips is really just stripping away that interest and converting it to more of a zero coupon bond. Okay, so look, here's the price of a 30-year zero coupon bond over time and its yield maturity of 10%. So we see that as the time increases, the value of this zero coupon bond increases because you get closer to being able to collect the full par value. So in the beginning life of this bond, it's valued at the lowest point because it's very far away from you collecting any actual interest. And when you get closer to the year where you're going to get that interest, the bond increases quickly. So it's really a waiting game when you buy these bonds as far as getting your money. Now, if we talk about after-tax returns, we have to look at bonds. Most bonds you pay taxes on. So you do want to look at what the tax implications of these bonds are going to be. So you have to really know what your taxable interest income, what your tax rate is to sort of calculate this. So we want to look at, when you get your interest payments, you're going to pay tax on your interest payments and you're going to pay tax on your capital gains. So this is something that investors need to contemplate because the higher taxes you pay, the lower returns you're going to get on bonds. And that's why those government municipal bonds are attractive because you're going to pay little to no tax on those, but you're going to receive them at a lower interest rate. So you want to look at what is the fully taxable equivalent of those bonds so they can be comparable. So investment grade bonds, these are bonds that have a higher rate of quality. So when we're looking at either Standard & Poor's or Moody's, they're going to grade like a letter scale A through F. The higher, the closer you get to the AAA, the better the investment the bond, better grade investment the bond is. And now, if it's below the level BB, then that would be more speculative, or what we used to call junk bonds. But turns out no one likes to be called junk anymore, so we changed it to speculative grade or high risk bonds to reflect the higher risk and therefore the lower rating. So these rating agencies, there's two big ones, Standard & Poor's and Moody's, and they have similar trading systems where Moody's will use upper and lowercase letters, and Standard & Poor's would just use uppercase letters. And just like a letter grade in many countries, A is the best. So A is high quality, AA is higher quality, AAA is the highest quality. And the speculative starts at the B level, and then very poor is the C's. So this is independent agencies that are going to investigate and rate the bond's quality. They're not right 100% of the time, though. In fact, they were in the Great Recession. They were giving mortgage-backed securities very high quality ratings on those bonds, but they were actually junk or very poor status when the reality of the bond's qualities came out during that recession. So how do we determine bond safety? We could look at the coverage ratios, so we could look at a company's earnings to their fixed costs to see how much money they're making versus how much interest they have to pay. We could look at how leveraged the company is, their debt to their equity. And we can look at leverage ratios, something that we're going to talk about more when we talk about the financial statement analysis. But the liquidity ratios are the current and quick assets. We're going to look at their current assets to the current liabilities, just to get a sense of how strong the company is in their financials. Now, profitability ratios, we could look at the return on assets, the return on equity to measure how profitability the firm is, or I should say how profitable the firm is. So more profitable firms have safer bonds. So if we look at the cash flow to debt ratio, this could also tell us how well the company's managing the cash. And companies that manage their cash better have more stable, more lower risk bonds. So here's an example of, if we're looking at bond levels from the best bonds to the worst bonds, which represent by C, we could look at these different financial ratios, and we could see how the changing of these financial ratios are going to affect the quality of bonds. So a lot of these bond ratings are based on the financial aspects of financial ratios of a corporation, and we can quantify these averages of performance, and this is a chart kind of displaying. And again, we're going to be talking about these financial ratios in a later chapter, but basically if they have the companies with the better set of operating and financial profits and better debt management are going to have a higher rating. As you can see, this kind of displays in this chart. Okay, so what is a bond indenture? So it's a contract between the issuer and the holder. So an indenture is just really a contract. Now, I just want to go back to talk about the bond ratings just for a second, because I had a thought. So the what we call a rating agency, is important to define the characteristics of the bond itself. So the rating agency has to look at the coupon, the maturity, the call features, and the bond rating agencies are institutions that perform extensive financial analysis, not just looking at a few financial ratios here. I don't want to give you the impression that they just look at these 7 financial ratios here. They do an extensive financial analysis on companies issuing bonds, and they want to look at to assess the credit risk associated with any particular bond. So the ratings of these agencies they're going to publish the credit risk embedded in the bonds, and they're going to talk about this credit risk. And so fixed income investors were going to look at these bond ratings. So they're essentially grades like you would get on a homework assignment that the rating agencies give the bonds. So the letter grades correspond with a certain level of risk, and the ratings are important because of the municipal and corporate bond markets. They are one or more of the rating agencies, like we talked about, Moody's and Standard and Poor's. They regularly evaluate, and they can change these ratings as things change in time. So how the ratings work is when a new bond comes to market, professional credit analysts, this is what their whole job is, from these agencies, are going to estimate the likelihood that the bond issuer will default on the obligations to pay the principal and interest. So that's the main thing that they're looking for. So the rating agency has to study the financial records of the issuing organization to assess the prospects, how well they are doing. So you might expect the firm's financial strength and stability are very important to determining the appropriate bond rating. Although there is far more to setting a rating than just cranking out a few financial ratios, which we see on this slide, a strong relationship does exist between the firm's operating results and the ratings of its bonds, for sure. But generally, agencies grant higher ratings to firms that generate higher profits and borrow less and maintain higher level liquidity and have stronger cash flow. So this subset of ratios here is what's basically showing that. And what investors would like is, the safer bonds are going to pay less interest. So this is really what's going to correspond to risk. So, what investors can do, they're going to watch these agency ratings because ratings are tied to bond yields. So specifically, the higher rating, the lower the yield you're going to receive, with everything else being equal. So, for example, a highly rated A bond, might offer a 4.5% yield, but a triple A bond might offer a 4% yield. So the bond's rating also has an impact on how sensitive the price is to the interest rate movements, as well as to changes in the company's financial performance. So junk bonds or speculative bonds are going to respond much more aggressively to changes in the company's financial position if it improves or deteriorates than investment grade bonds would. So the most important bond rating, I guess the most important aspect is that bond ratings serve to relieve individual investors of the drudgery of evaluating the investment, the review and the investment quality of an issue on their own. So largely these institutional investors often have their staff of credit analysts who independently assess the creditworthiness of various corporate and municipal bonds. So individual investors have little gain from conducting their own credit analysis. So credit analyst is a time-consuming and costly and demanding job. So this is why these services are so valuable. But keep in mind that these rating agencies, they can make mistakes and they can sometimes misinterpret what the risks are for a company. So it could be misleading at times. Okay, so back to this slide. A bond indenture. So it's going to find the contract between the issuer and the holder. So it just means that bonds are like contracts in that anything can be really written in there. So you have to really read those contracts to see what provisions you have. As far as one important thing is to think about, if the company goes bankrupt, who gets paid back first? Who has a more senior claim and who has a less senior claim? And then the good thing about bonds is they come before stocks as far as being paid back when a company goes bankrupt. Now let's talk about a sinking fund. Think of a sinking fund is very similar to an auto loan or a mortgage, where the person who borrows the money is going to periodically pay back not just the interest, but also a portion of the principal before the bond matures. So in most corporate bonds, you're just paying interest for the life of the bond, and then you pay the full value of the money you borrowed back at the end of the life of the bond. But these sinking funds make these corporate bonds act more like mortgages or auto loans, where you're paying both principal and interest in every payment. It's also similar to student loans. Okay, so as far as bond indentures, we have a subordinate clause, which could say that any additional borrowing stipulating senior bondholders are paid first in the event of a bankruptcy. So this is an important clause to kind of really see where your bond is going to fit in as far as how it's going to be paid back in relationship to other bonds. So because you really wouldn't want a company to issue new bonds that are going to be paid back before your current bonds. So these are important clauses. Collateral, some bonds will be backed up by certain assets in case of default. And for corporations, it might be buildings, it might be trademarks, it could be I guess a host of assets they have can help. And if a bond is backed up by collateral, it's going to be less costly for the firm to issue because it's safer. And that's why generally banks are willing to lend individuals, large sums of money to buy a house, because the house is going to be the collateral in case you don't pay back the loan. So the debenture bond may not be backed by any specific collateral, just by the faith of the company to pay back the bond. Okay, so yield to maturity and default risk. So the stated yield is the maximum possible yield to the maturity of the bonds. And there's going to be a default premium that's incremental to the promised yield that compensates investors for default risk. So basically, if the company is more risky, more likely to default, their interest rates are going to have to be higher to compensate for that. This is a contract of a callable bond that a little small print here to read, but basically it's going to be, this is for Apple, and this is going to be the provisions as far as how and when the bond can be called and at what price. Okay, so if we look at yield spreads among corporate bonds, so in this particular slide, it's hard to see because this top line here, this bottom line here, will start with the best, highest rated bonds. Here is the investment grade, and then here is the high yield or junk bonds. So you can see when the economy is doing well, you're going to have a low spread between the three, the highly rated and the lower rated. But when there's a financial crisis, like in the Great Recession, you'll see a big disparity between the higher rated bonds to the investment grade to the junk. So when this is one of the things that we're talking technical analysis. If you start measuring the spreads between these levels of quality of bonds, and you see these spreads start increasing greatly, you know that you should probably get out of stocks because the risks for corporations are greatly increasing. And then on the other side, when the spread starts to dissipate and return to a tighter spread between the three types of ratings on bonds, then you might want to invest in stocks because they're saying that bond market is saying that speculative stocks are less risky. So this is an important leading indicator for investing in stocks. That's why it's important. But you can see through times of economic turmoil, you'll see that the speculative bonds are going to be more reactive to interest rate changes or risks than the higher yield, the higher rated bonds. Okay, so let's talk about credit default swaps. So a credit default swap, sometimes known as just a CDS, is in effect an insurance policy on the default risk of a bond or a loan. So to illustrate this, say an annual premium in early 2010 for a 5-year Greek sovereign bond, CDS, credit default swap, was about 3%, meaning that the CDS buyer would pay the seller an annual separate premium of $3 for each $100 of bond principal. So the CDS seller collects these annual payments in terms of the contract, but must compensate the buyer for the loss of the bond value in the event of a default. This was originally envisioned, the credit default swaps were designed to allow lenders to actually buy protection against losses on sizable loans. So the natural buyer of the CDSs would be large bondholders or banks that had made large loans and they wished to enhance the credit worthiness of these loans. Even if the bond issuers had shakier credit standings, the insured debt would be as safe as the issuer of the CDS. So the investors holding the bond with a BB rating could participate and raise the equal to the quality of a AAA bond by buying the CDS to the issuer. So it was a way of, moving the risk from the bonds to the default swaps. So it's sort of an insurance policy saying if the bond's going to default, the CDS will make up for it. So this is a way of kind of buying protection on your bonds to make the bonds less risky. But these credit default swaps there was a problem in that And we're going to go over that in a second. So in the financial crisis, we know that these credit default swaps were an issue in they were the counterparties was questioned whether or not they actually had the ability to support the credit default swaps they took on. So again, this is a bit of financial engineering where the people who have the bonds want to buy some insurance against default, and other companies who want to speculate on that default will take the other side of it, compensating the borrower if it does default. Now, the problem occurred where a company like AIG took on so many of these credit default swaps, they really did not have the money to compensate in case all of or majority of these bonds did go into default. But they thought that would never happen. But then, lo and behold, all these mortgage bonds did go into default, and they really weren't able to cover their default credit swaps. So the U.S. government had to step in and lend them some money to keep them afloat, and they were designed to be too big to fail. Okay. And we could look at the price of CDSs in Greece, so we could see that as the Greek crisis started to increase, the price of these 5-year credit default swaps also changed over that time period from here to here, where this is where the Greek crisis sort of incurred. Okay, let's talk about the yield curve. So this is in this book, we're going to be talking about the yield curve in relationship to U.S. federal treasuries in general. So we can calculate a graph that's going to be a visual representation of yield to maturity function on different maturity positions of bonds. So we call this a term structure of interest rates. And it's going to be a relationship between the yields and the maturity across different types of bonds. So say short-term treasuries, intermediate treasuries, and long-term treasuries are going to be the bonds we're going to be looking at. So we're going to be plotting their yields on a time scale. And we have some examples of those in a second. So we have some explanations of how and why these yield curves change. So we have the expectations theory. So the expectations theory say that the yield curve reflects investors' expectations about the future interest rates. So the theory argues that the relationship between the short-term and long-term interest rates today reflect what investors' expectations about interest rates are going to change in the future. So when the yield curve slopes up, long-term rates are higher than short-term rates. The expectation hypothesis interprets this as a sign that investors expect short-term rates to rise. That's why long-term bonds pay a premium compared to short-term bonds. People will not lock in their money for long-term investment when they think interest rates are going to rise unless the long-term rates is higher than the current short-term rates. Okay, so let's look at a few of these on the next slide. So here we can look at, here is the yield curves that we have from different periods of time. So this would be a pretty common upward sloping yield curve where the short-term rates are lower than the long-term rates, but there is a small dip here. This is looking at the maturity. We had a very low interest rate for the shorter term maturities and then a much higher. So this would basically say this upward sloping yield curve is more distinct here. We're saying that they expect interest rates to be higher in the future than the short term. And it's typical after a recession to have an upward sloping yield curve like that. Now, a downward sloping yield curve here, where the short-term treasuries are paying more interest than the long-term treasuries, is unusual. And typically, whenever this occurs, it predicts a recession that's going to occur within 6 to 8 months afterwards. So here we see that in 2000, this definitely did predict a recession. And then we have here in '89, this also a a downward sloping yield curve, although the shorter term rates do rise, but then the intermediates are higher than long term, and there was a recession 2 years later. So these are different yield curves, and they all have their own different explanations as to why. So we could calculate the 2-year cumulative expected returns by this formula here. And as far as we have that. There are other theories like the liquid preference theory that shorter term bonds should pay lower interest rates because they're more liquid. And there's a market segmentation theory that's going to say that each segment, short term, intermediate, and long term, are independent of each other and have their own supply and demand characteristics. So these are different ways that you can use these yield curves. And what's interesting about those yield curves, which I was talking about before, is that it can help bond investors can use these yield curves to make investment decisions. So analyzing the change in yield curves provide investors with information about future interest rates and the movements of future interest rates. So remember, the bond market is supply and demand, people buying and selling bonds just like they do stocks, and that moves the price of bonds up and down, and that's going to change the current interest rates on those bonds or the yield to maturities. So this in turn is going to affect the price and return of different types of bonds. So for example, if the entire yield curve begins to move upward, this usually means that inflation is starting to heat up or is expected to do so in the near future. So in that case, investors can expect that interest rates too will rise. So under those conditions, most seasoned bond investors will turn to shorter-term intermediate treasuries or maturities to provide a more reasonable returns at the same time minimizing their exposure to capital losses that would happen when interest rates go up. So these are just how these yield curves are very tightly looked at as far as trying to figure out when to buy and sell bonds for investments. Okay, so the forward rate, this is something we're going to talk about. So it's going to inferred short-term return on investment for future periods. And it makes the expected total return of the long-term bond equal to the rolling over short-term bonds. So this is just a formula to calculate what we call a forward rate in the bond market, which is something that so this forward rate is kind of like looking into the future a little bit on the rate, and it has a particular formula to calculate what we think the forward rate is going to be, and this can help bond investors decide whether to buy and sell bonds in the future. Here's a slide. I actually was talking about this before. I jumped the gun, but the liquidity preference theory is saying if you want an explanation for why there's generally, most of the time we have a upward sloping yield curve where the interest rates for shorter term treasuries or bonds are lower and longer term bonds are higher. So we consider the shorter term 1 to 5 year bonds to be more liquid because you're going to get your cash back within 5 years compared to 30-year bonds were less liquid, we call them. So since investors prefer liquidity, that preference leads to the acceptance of lower interest rates. So we would normally see that shorter-term maturities will have lower interest rates. So this preference is what we should see expressed in the yield curve. And 90% of the time we do see that. So when the yield curve is flat or downward sloping, we know that something unusual is happening in the economy that's causing investors to shift their investments between longer term bonds and shorter term bonds. And this liquidity preference is there to kind of explain why that is. So here in this graphic, we could see that here we have as maturities grow and longer in time, this liquidity preference is also going to change between the expected return, the forward rate, and the yield to maturity. So when the maturities are only a few years, this liquidity preference is going to be lower as far as the premium required for liquidity is going to be lower compared to older maturities. So this is going to be two examples. A is going to be increased expectations of short-term rates combined with increasing liquidity premium. And B would be declining expectations of short-term rates. So when short-term rates are expected to decline, combined with constant liquidity premium. So this would be what we'd call a humped or an inverted shaped curve. And that's what we were referring to back here. These are the humped or the inverted curves. These are unusual circumstances. So this is the most common circumstances where the liquidity premium is going to be moving up with the length of maturity. But some bizarre circumstances where the short-term rates are being lowered, and that's usually by a treasury action or a Fed action where they're lowering short-term interest rates to help the economy, that's when we could see this example B take place, which would result in a downward sloping yield curve, which is less common. Okay, so the spread of the 10-year versus 90-day treasuries, again, if we look at this slide, here's the difference, but we have the black line is the 90 days, the blue line is the 10-year treasury. So the 90 days is short-term, blue is long-term, and we see that sometimes they trade closely together and sometimes there's a bigger spread between them. So when there's a bigger spread, there's usually, it's intermixed between fear and Fed action between changing the interest rates. So when there's this big disparity between the long-term and short-term, there's more uncertainty. And when it's closer together, there's less uncertainty about rates. Okay, so that's chapter 10. Look for the next video in chapter 10 is I'm going to use Excel to show you how to do the various mathematical functions to calculate bond prices and yields. Thank you.